the 1890s depression, 1929 Great Crash, 1999 Internet Bubble, 2007 GFC, and even the 2020 COVID crash. All of them were predicted by a single market cycle, published all the way back in 1875, so 150 years ago. So someone from way back then had the foresight to predict every major and minor crashes that were going to happen. Can you imagine? Can you imagine having this map in your hands? If you knew in advance when to sell before the GFC and buy back 2 years later at its lows, then sell again in 2019 and buy back in 2023, just following this alone would have grown $10,000 into over $70,000 in the S&P 500 alone. And of course, this cycle works for other stock market correlated assets as well. So you apply to crypto like Bitcoin and you start buying and selling from 2017, you would get a return of 3,549%. So the real question is, if this pattern has worked for over 150 years, could it make you rich in 2026? So in this video, firstly, I'll reveal exactly what this cycle is and why it's so powerful. Secondly, I'll explain the risk and why not everyone who knows about it can become a billionaire and the ways around it. And thirdly, I'll show you exactly how you can use it alongside the real estate cycle to prepare for 2026. Now, if you're new here, I'm Ace and I have a bachelor degree in finance and equity investment, and I built a 400k plus portfolio in just 5 years by following Warren Buffett's principles and studying cycles just like this one. And I didn't start rich. I learned by trial, error, and eventually by discovering the power of cycle positioning. Now, to begin this, to be honest, I was going to tell you the story of, when I first invested in the S&P 500 with only $500 in 2019 and lost most of my money. And that if I knew when we were reaching the peak, I would have waited until when the price dropped by, X percentage in 2020 to invest, etc., etc. But the reality is, if you're only just getting started, I would recommend just investing a small portion straight away regardless, because time in the market will help you learn when you're beginning. Being on the sideline would probably help you with maximizing your ROI, yes, but I reckon the learning and experience you would have gained from being involved and invested as a beginner is a lot more valuable than, just being on the side and doing nothing. Since you can understand the emotions that one goes through and apply that experience to the next recession. But if you've been investing for a while, then working around the cycle timing is very, very important. Now, a quick disclaimer, I am not a financial advisor. Everything I share here is only my opinion for education and entertainment purposes only. Always do your own research before investing. Let's start with the first point. Point 1, what this cycle really is. Now, the Banner cycle was released and created in 1875 by Samuel Banner, a farmer and commodity trader who noticed markets rise and crash in repeated rhythms. He published a chart that marked years of panic, prosperity, and depression. And you may have seen the same chart circulating on social media from time to time. Now, the reason why this cycle started resurfacing is because people start to see how scarily accurate it really is. The Banner cycle accurately predicted the 1890s depression, 1902 crash, 1910 panic, 1929 Great Depression, from 1999 to 2008, all the way to 2020, and most recently, the extended chart predicted a recession in 2023. Now, that's not too bad considering the forecast was made almost 150 years ago. So, how does it all work? Now, when Banner created this graph, he believed that there was a pattern to time. He believed that the pattern followed a rule that does not change because of war, panic, or elections. And to uncover this cycle, he uses a collection of 3 main factors. Historical price data, so it means past pricing data. Secondly, weather patterns, so how the weather changes from year to year. And lastly, astrological phenomena, like the sun and moon cycles and how that affects human biases. And through this, he discovered the cycle, and Banner made a name for himself as one of the most accurate economic forecasters of all time. Even Edward R. Dewey, the director of the Foundation of the Study of Cycles, analyzed Banner's forecast over a 60-year period and called it the most notable forecast of prices in existence. So, how do you actually read the cycle? Now, this cycle has 3 lines. Line A here marks the years of major panics and severe crashes. Line B shows milder booms and busts where markets gets overheated but not destroyed, and line C marks the years of low prices and the best buying opportunities. The idea was very simple. Sell when optimism is extreme and buy when despair is everywhere. Now let's get to the second point. Point 2, the risk and why not everyone gets rich. So you might ask, if this cycle is so accurate, why is not everyone who knows about it a billionaire? And there are two main big reasons for it. Firstly, most people don't even know about it. The banner cycle isn't taught in schools and it's not mainstream. Instead, people follow hype, headlines, or hot tips. Secondly, this cycle is not perfect. Like any forecasting tool, it has a margin of error. Sometimes the top or bottom comes a year or a year and a half too late. If you acted too rigidly, you might have sold too soon or bought too late. However, it did accurately predict the 1890s depression, 1902 panic, 1910, 1929, and so on up until now to the GFC and COVID crash. It also gives a warning of the next recession going into 2026, which correlates with the real estate cycle peaking, with a declining trend into the early 30s. So overall, if you do take into consideration the small margin of error and include it in your long-term investment plans, you still can make a big chunk of money even if you're a year early. Now, I personally combine this with other reliable indicators to minimize the margin of errors. So technical indicators like the Shiller PE ratio, total debt to GDP, yield curve inversion, and herd mentality indicators such as my aunt's from Vietnam, which is the most reliable one thus far, and it usually comes 5 to 6 months away from the crash. Let's go through each one briefly. Now, the Shiller PE ratio measures how overvalued or undervalued a market is. It is calculated using the market value of the S&P 500 index and dividing that over their average earnings. Now, currently we're at a PE ratio of 39.56, and this is something to be worried about because the previous high in 2021 was 38.58 before the crash. In 1999, the internet bubble was at 43.31, so if we do get anywhere near the 40 zone, I would be slowly unloading my holdings. And of course, you need to integrate this with other indicators as well, one being the total debt to GDP. Now this measures the total debt a country has to its GDP. Now total debt here includes household debt, private debt, and public debt. A high debt to GDP ratio indicates how leveraged up a country really is. The higher the leverage, the more likely the economy is going to crash. Now I'm talking about the US for now, since Australia tends to follow the US cycles and seems to be more dependent on US market performance. Now currently we are 270% total debt to GDP, and this number is pretty high given in 1999 the number was only 260%, and in GFC it was 350%. So according to best practices mentioned by Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates, you should start unloading around the 300% total debt to GDP mark. The third indicator you should also look at is the yield inversion curve, which details the short-term to long-term yield. If the yield curve starts going from flat to, inverted, it's a very strong sign that the market is about to fall within 8 to 12 months, and it's been very accurate. Since 1955, every US recession has been preceded by a yield curve inversion. Now currently, the yield curve has gone from inverted to flat after our last recession. However, the next time the US government decides to raise its short-term rate and inverting the yield curve, it's a sign to slowly also unload your holdings. And lastly, my favorite indicator and my most reliable one thus far with 100% hit rate is the aunties indicator. So what is the aunties indicator, you might ask? Now I do have a few aunties back home in Vietnam, and every time I come back, I would eavesdrop into their conversation. Why? Because every time I hear them talking about investing in the stock market or crypto, it will be exactly 8 months from the crash. And it's been happening exactly 3 times now, and it's helped me sell all my positions at an extremely good time, earning me roughly hundreds of thousands of dollars. So if you do have aunties who talk a lot and love trying out new things and get rich, make the best use out of it. Finally, let's talk about the third point, point 3, how to use this cycle for 2026. Now let's see how the banner cycle has changed over the years as we gather more data. To really see how the cycle has changed, let's look into a cycle very similar to the banner cycle in the first place, the 18.6 year real estate cycle. It's one of the cycles that Berner used in formulating his work. Now, I want to look into this because unlike the Berner cycle, which has not been updated in the last 150 years to account for new data like wars, the 18.6-year real estate cycle founder, Fred Harrison, is very much still alive, and there's a whole team behind him working to always keeping the forecasting up to date. Now, with the 18-year real estate cycle, there are two market peaks, one being the mid-cycle peak and the other one being the end-of-cycle peak. The mid-cycle recession or peak is driven primarily by an overheated stock market, while the end-of-cycle recession is a land-driven recession. And since land has people from all income brackets involved in it, while the stock markets are primarily owned by the richer 1% of the people, a land-driven or end-of-cycle recession is a lot more severe. So when you're bringing the same concept to the Berner cycle, you can see from the start, row A marks the peak of the real estate cycle in the US, so the end-of-cycle recession, while row B is the mid-cycle recession, so the less severe one. However, interestingly, according to new data from the 18-year real estate cycle, once you get to the Second World War in 1945, the end-of-cycle peak switches from row A to row B. In other words, after the Second World War, row A is now the mid-cycle recessionary point of the real estate cycle, while row B is the end-of-cycle peak. Therefore, we can say that the Second World War switched the timing of the final peak of the US real estate cycle with the mid-cycle peak. It interrupted the rhythm of boom and bust. Why? This is because war policies can easily stop booms and busts in the land market due to the government just changing their resource allocation, government spending, and economic priorities. And that's why it's very, very important to keep yourself up to date with data. This will help you understand when there will be a change in market momentums or cycles. And looking at the dates on the Berner chart, row B marks the next end of cycle real estate peak as 2026. Now, knowing that the Berner cycle can be 1 year off and basing off our other mentioned indicators, we are looking at a market peak around end of 2026 or maybe early 2027. And that should give you a good time frame to slowly reduce your position as we get near to that future. Well, there you have it. If you do want my full playbook on cycles and all the signals I track, make sure to follow my newsletter, link in bio. A question, and I want to hear from you. Do you think 2026 will really be our next big peak, or will history surprise us? Drop your thoughts down below, I'll be reading.